We are officially in a bear market, which is a decline of 20% or more from the market's most recent highs. In this case, we're down about 25%. No one knows with 100% confidence or exactitude how long this bear market will last and how deep it will fall. But you want to keep in mind that we did have an 11-year bull market run where the market was up almost 500+%. So we've had some substantial gains over the past 11 years. That said, I do not think it would make sense to start selling off investments in this type of environment because if you sell a stock right now, you're simply just locking in long-term losses. You want to make sure you have a properly asset allocated, well-diversified portfolio that fits in line with your preferences towards risk, your time frame, and your ultimate aspirations for that money. Now, I was asked by some, should I start buying stocks right now or should I start investing additional money? And I think the answer to that is yes. But I think you want to do so in a very prudent and judicial fashion. And you do that through dollar cost averaging in. Many of you are already doing that through your 401ks, where every other week you're putting money into the markets. I think that's the best way to go about doing that. I also think it might make better sense to start increasing your contributions by maybe 1 or 2 percentage points, depending upon how much you're already contributing to your 401k plans. Now, if you have outside or excess cash, I think you want to take a dollar cost averaging approach with those dollars as well. So for example, if you have, let's say $10,000 in cash, it might make sense to start putting in $1,000 every 2 weeks for the next 20 weeks. If you have $100,000 of cash, maybe $25,000 per quarter or so. But you want dollar cost averaging in to the markets over time. Now, I've been asked about buying companies that potentially could do well in this environment or those that may not necessarily do well. And someone brought to my attention Amazon. Because they feel people will stay home due to the coronavirus and shop more online. And I understand that strategy, but the problem is, number one, many of you already own Amazon through your 401ks and IRAs if you have mutual funds and ETFs. But also Amazon trades at $1,700 per share. Most people don't generally buy stock for more than $100 per share, so it's already expensive. And then if you do buy it, you're taking on additional risk. So I think the best way to kind of play those types of strategies, so to speak, is to use sector-based ETFs. Now, within the S&P 500, there are actually 11 distinct sectors spread across 69 different industries. So, for example, within healthcare, there's actually 6 distinct industries ranging from biotechnology all the way up to pharmaceutical sales or pharmaceuticals in general. So you could play it that way by using a sector-based ETF. So remember, Warren Buffett famously once said, be fearful when others are greedy and greedy when others are fearful. Take care.